Cause I'm an island boy, and I've been trying to make. Oh, I'm an island boy. I'ma just island boy. I'ma just island boy. I'ma get key white going. You're gonna keep that going.
Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 10th, 2022. I'm David Zarling. I'm here with our resident ornithologist, Ian McMillan. S&P 500 is currently sitting at 3910. Plenty to cover this week with the amount of selling we're seeing this Friday that began yesterday. But there's plenty to cover. Where would you like to start?
What is that? Is that a bird person?
Yeah, it's a person.
I guess I should know, considering I am one.
Yes, you are. It's a branch of
Zoology.
Yeah, zoology that concerns the methodological study of consequent knowledge of birds and all that relates to them.
Well,
I butchered that. I literally have it on my screen to read, and I can't even read it.
It's hard. I mean, it's not an everyday word, so.
Well, I messed up. I can't say that word. Zoology.
Yeah, I thought we were going to be talking about, some different things here on the podcast this week than probably what we're going to cover, given how things have transpired over the last about, I don't know, when the selling started yesterday, last 24 hours.
Yeah, correct. The consolidation that we had in something like the S&P 500 between 40.80 and 41.80.
Really? It'd been nice.
Yeah, it'd been nice. It was a nice consolidation that you would see if an uptrend was going to be reclaimed. With the 41.75 area being extremely important, prior lows, if you want to call those the Russia lows or mid-March, early March lows, we bumped up against those, we consolidated, and then yesterday afternoon, Thursday, started breaking down out of that and had followed through today, along with, your...
Not where I thought the consolidation would lead, but that's why we play the game, right?
Yeah, well, and it's tough, right? Because there's two ways to view it, like consolidations resolve in the direction of the primary trend. Was the trend going to be up? It would, like, if the consolidation broke to the upside, yes, but the consolidation didn't. It broke to the downside, confirming further downside. We continue to see lower highs and lower lows, which is the very definition of a downtrend. And so that's what we continue to see in the marketplace.
That's true.
I mean, even we've talked in the past about the things that continue to go down. We need them to stop going down. We've talked about your ARK Invest, your ARK Innovation, your IPOs, your SPACs, your marijuana stocks.
And a cannabis pot bounced for like 4 days. It is. I mean, oh my God, it has to be the worst. Is it the worst area in the entire world?
It's got to be up there.
I mean, outside of like Pakistan.
Yeah, no, it's the marijuana stuff
is also at pretty. No, I mean, marijuana's it's all-time lows.
Right, and
from these ETFs. I mean, if these ETFs had come out in 2015. Probably not all-time lows, but
right. But you had a bounce the prior week. I know that when we recorded a podcast with Dan 2 weeks ago, that actually we recorded that, and I remember us talking about price in the S&P 500, being in the close to 3,800, and it reversed higher. And here we are at 3,900. So are we marking a bottom again in this podcast? I have no idea. You have to be open to the idea that there's a potential for a double bottom here around 38.95, 3,900.
There's been support here.
Buyers showed up there last time. And it goes back to is it truly buyers or lack of selling or short covering? What we know, what the facts are, is that price continues to confirm lower highs, lower lows, very definition of a downtrend. It has confirming information from a downward sloping 200-day moving average, downward sloping and 50-day moving average that's below a 200-day moving average. We barely got back to a 50-day moving average on something like the S&P 500 and have since reversed off of that pretty aggressively. So sellers have control. There's no other way to say it. Sellers have control. And that's how we have to manage risk. So with that, if we were to see this be some type of bottom develop here, which is the least likely scenario, but it's got to be a scenario. What are the things that have held up during this? Are there anything, like, we like to look at what are the areas of strength?
Well, China had been doing well. We'll see if U.S. stocks pick up, if that continues as well, or maybe Chinese stocks, I guess it's a non-zero chance they could go into their own bull market as U.S. stocks continue to sell. But yeah, China had held up well, particularly from a relative basis the last month. Aerospace had looked strong. Even home builders had held up well.
Until today, right?
Yeah, and this is all really up until, like I said, the end of yesterday's session and into today. The dollar has turned around. Probably one of the headwinds, probably not helping stocks.
Yeah, it's back at 104. Its price has been wrapping around the prior highs that date back to March 2020 and December 2016. We're now back above that level. That's around 102.80. And we've seen, now this may just be a situation where the trade weighted dollar like the DXY Dixie wraps around that 102.80 level and then gets resolution out of that type of consolidation, or what we just saw was some type of retest and we move higher in the dollar, which will have ramifications all over the place.
Agree. Europe. How about Europe? Europe has shown a ton of relative strength over the same, time frame. You look at these relative charts, really over the last month plus, and you had, Germany's given up 5-6% of alpha over the last week.
Well, one area that we had noticed had shown strength was, and if you use the currency hedge product, was Japan.
Japan, yeah.
And now Japan's on the verge of recording a false breakout, which has been a theme that we've seen take place here for a while. And Dan and I talked about it 2 weeks ago, just the amount of false breakouts. False breakouts meaning price moving up against a horizontal price level. Let's, for our listeners, let's just paint a picture. Let's say it's $100. You keep going up to $100 and it sells off. And that might take place over something like 6 to 12 months. And then it clears 100. And that typically can be a positive characteristic where it has blue skies ahead of it. Demand is in control over supply and price moves higher. Where the problem lies is if you don't have a risk management process for when that doesn't happen, meaning there is no follow through, and you get a false breakout. You break above 100, and then all of a sudden you're closing quickly, a day to a few days back below that level. That's what would be called a false breakout. And from false moves come fast moves in the opposite direction. And we've seen that in how many places, Ian?
So many. You've seen it on big time frames like Deere.
Yeah.
You've seen it on smaller time frames on individual names, right? You saw it on boat.
Yeah, that's a big one.
Let's talk about shippers. Definitely, these areas that had held up well. You got to talk about shipping, which, Tuesday closing at all-time highs, and it's now, the last 3 sessions off over 12%.
Well, and it's one of those things why we have a risk management process. When we look at something like SBLK, which is Star Bulk Carriers, which is something we did own in the portfolio because shipping was doing so well, but quickly sold when it broke back below its $30.80 level. when that happens, false breakouts need to be honored, because how often do we see in markets where those fail and price quickly moves in the opposite direction, especially in this current market environment that is very abundant, that type of situation, which is not a characteristic of bull markets. To see false breakouts fail is not what you see in bull markets. You see that in bear markets.
Yeah. And that's what happened. I would say that there were more opportunities. So while the bounce hadn't been as big that we saw in March, in March we had a 11%, if you want to call it, off the February lows, but up through the March high. So about a 11-12% rally.
Mm-hmm.
This was if we go off the intraday lows from May 20th, this was a 9% rally. But there were more opportunities from a technical perspective that kind of showed that, under the surface, things, were genuinely seem to be improving. There were certainly still stocks holding up. But obviously that has been wiped out. We'll see if they finally come for energy. That would probably be pretty telling.
Yeah, for sure. The energy would be that one area that we've talked about plenty as having strength.
Yeah.
Whether it's Exxons or Chevrons of the world, or, Valero, you name it. These are some of these stocks had been doing or have been doing very well. And now they're reaching levels where maybe they're the last pieces to go to a correlation of one, where everything is selling together. I think of metals and mining was that.
Oh my gosh.
Just a couple of months ago, like metals and mining was a place to be.
And not a bad rebound here. I would put that in one of the areas that, held up nicely.
Yes, for sure.
Looked real nice up until 2 days ago.
Well, and originally it was a leader February.
It was
into March, even first part of April. But since became weak. So we've seen the dominoes fall off, meaning the things that have had relative strength, with the last holdouts being basically energy, and in some ways I would say healthcare, only until maybe 2 weeks ago. And healthcare is that, it's one of the largest components of the S&P 500. And I know it was either you and I talked or Dan and I talked on one of these podcasts about XLV and the 125 level. And if that breaks, that's kind of like one of the final big pieces of the pie that would be moving to the downside. And that would be
there today, and they bounced it. So
yeah, and that's fine.
Yeah.
They can bounce it, no problem. I mean, we still got a gap there. We're still at an extremely important level at 125 on something like XLV. If that were to break down, if that level would be broken, that would be further confirmation of what we're seeing across everything else, is just continued weakness, and that supply is in control. Sellers are in control.
Well, and if we stay in the healthcare theme, one thing I mentioned earlier this week was on Charles Payne, and we talked about Russell 2000. And one of the reasons I said I, really wasn't a huge believer quite yet of Russell doing anything is because of biotech, and biotech being such a massive weighting in the Russell 2000. I would it bounced better than, cannabis did, but I would put it in there on our list earlier from one of the areas that, from a technical perspective. And when I say that, there were lots of areas that did recover their February and March lows. Biotech, ARC, those types of areas. Software, like I don't think XSW, that was another one, never even got back up to its low. So from a technical perspective, much weaker, never even reclaimed any type of intermediate term level.
Right.
And biotech,
well, speaking of the healthcare and biotech space, two high flyers that are currently struggling right now are Moderna and Pfizer. And whether or not, and we've talked about this in the past as well, is is this the price moves first, news happens second. It's not the
Yeah.
other way around. And so are we portraying some type of information, because in fairness, Moderna
Awful bounce from Moderna.
and Moderna is 74% off the highs that were in August of 2021. I mean, it's down 74%.
Yeah.
That's a lot.
And when I say off, right, so off its lows, mid-May lows, it's up 17%. But again, look at that chart and tell me we're back to those lows. Yes, in 2 days, we've given, it's just a very weak area. And I think Moderna is a perfect example of, we're up 17% over basically 4 weeks. And sellers and that was wiped out in 2 days. That's how much people really don't want to own these stocks right now.
Right. And one of the last leaders that I think of, or the remaining leaders that had been in play, were things like United Healthcare.
Yes.
Eli
Big
Lilly.
Dow name, right? Is that number one in the Dow still?
Yeah, I think so. Eli Lilly is another name.
Yes.
And we're starting to see those crack. And what I mean by that is
Eli Lilly failed breakout.
Correct. Failed breakout with a pretty decent RSI divergence. So are these previous things that were holding healthcare up failing? And if so, that's going to take the rest of healthcare with it. And that's that, again, it's not like healthcare is a small piece. Like we've already broken tech down. And tech's 27% of that.
We've talked about that. There's no getting tech back until Apple and Microsoft to get above the levels that they need to get above.
Right. And
You're
so then
not going to do it.
Healthcare is your next biggest piece at about 14%. And then you've got financials, which are getting rejected. Using something like
financials, if we close right now, new weekly lows, closing lows. It's a horrible look. I mean, these weekly candles are.
And if you've got your 3 largest sectors breaking important levels, confirming new lows, we're talking upwards of like 50% of the S&P 500 in downtrends. Just looking at those 3 sectors, I'm not even talking about consumer discretionary, which also looks even worse, which is the 4th largest. And communication services, which we've also talked about ad nauseum. I mean, communication services since September of 21 is down 33%, 34%. And that's the 5th largest sector. Industrials, 6th largest sector in the S&P 500, that got rejected this week. XLI port level at $97.
And Caterpillar had climbed back up there, and it really gotten back up to that 230. Looked like they wanted, but no, it was just a gap fill.
Well, and we've covered on here before, and I apologize for saying it like that, but when you have over 100 episodes, you tend to repeat yourself on some things. But we've talked about, it's not about consumer staples when they're moving to the upside. It's about consumer staples when they're moving to the downside. You want to talk a little bit about that?
Yeah. And I've mentioned it a few times on Twitter. It's this failed breakout. We can really go back to late April, the failed breakout we saw in staples back then. And I forget, it was probably something newsy like Target or, someone's earnings. I don't remember exactly what happened. But so from that failed breakout, which we don't like in general, we especially don't like them in areas like staples. So down 11% since that breakdown, down for about 14, 15% from the highs. But it's just a bad look. I mean, you want to see people, if this were a market that investors were, the way I view it, if this were a market that investors were and market participants like, I want to be invested. I think we go higher, but I'm a little nervous. I'm just going to be in staples. That's okay. Seeing staples outperform to the upside, as long as the broad market's moving up, there's nothing wrong with that. But, and we're going to see staples bounce off a big relative level here today, most likely. You just don't want to see them. You don't want to be in a market environment where staples are going down less than the major indices.
Right.
Which is what we have seen for, really since, like I said, late April.
Mm-hmm.
And yes, they bounced with everything else, but really this move since late November, the staples relative chart has been in an uptrend, higher highs, higher lows. And it's looking like it's going to continue that way, except for the difference now is staples are also going down.
Yes. And that's the big difference. When staples are going down, along with everything else, that's that correlation factor going to 1, which is what we see in faster moving bear markets.
Yeah. And you're going to see, some managers have to come in and buy, right? Because they've got to be, we've talked about this multiple times there. You see also staples in buying in bear markets because portfolio managers who have cash mandates have to be long something. And they say, well, if I've got to be long something, it's going to be these super low beta areas. For
sure. So we've talked quite a bit equities, and I guess one of the pieces I want to kind of follow up there is, we talked Microsoft, or I want to talk about Microsoft and Apple, right? They were kind of the last holdouts. What are we seeing out of those two? Really, they're really important names.
They are, and they did not during this entire rally. And so the big two levels, the levels we have, talked about over and over and over and over and over. Apple was 156. I think we got over 150 for a day, maybe. And so Microsoft was 276, and we did get back up there on Microsoft to 276. You can call it 273. These lows, these February and March lows, the same behavioral lows we talk about on a lot of these charts, tested it and came back down.
Yeah.
And there's just, I don't know how the broad market moves higher the broad markets can move higher and they can underperform, and that's definitely possible. But unless you get 450 of the 500 stocks in the index to start moving upwards while these move down, I don't know.
That's just it. Your point is, Apple and Microsoft are over 11% of the S&P 500.
It's such a big ball to move. There's just not a wind. There's not enough wind to blow that ball in the opposite direction.
Right, and they're 22% of the Nasdaq 100. So those
you had energy up 42%, and that was your loan,
right?
And that did nothing for the major indices.
Yep. So it is a guilty until proven innocent market. We're allowed to do that, right? This isn't our fellow citizen.
And there were signs. Like I said, there were some good signs over the last couple of weeks. These major indices held up in these, I'm not going to say should have been, as if technical analysis didn't work this time or something. But what you would typically see coming out of a short-term bottom, a bullish consolidation, it can be accumulation or distribution, would have seemed right. If it was going to be a bottom, clearly it would have been accumulation. It wasn't. People were selling them. So,
yep. Well, we were starting to see a broadening out. We were starting to see areas like infrastructure, like you said, shipping, aerospace, even home builders. We're starting to see some things build out. We had May 25th.
China, for crying out loud. We joke about it, but when you're sitting there buying, last Thursday, we're, in Chinese internet stocks, and you're like, well, if we're buying, this, maybe it's not so bad, but.
Well, and May 25th.
You get a nice pop and then you're out.
May 25th, 26th, 27th, we had 3 days of 80+% up days. Where 80%, or more of NYSE participants are moving to the upside, that can be thrust-like behavior completely evaporated. We could talk about that more on the extended portion, but it's kind of like going out, you got that new patch of grass growing and you're like, okay, this is looking good. And then you go out the next day and all of it's brown. Okay, well, it's information. Like things were looking good, but they're not looking good anymore. And it can happen quickly. And that's basically what we've had happen over the last 2 days is non-confirmation of the green grass. We were seeing a broadening out, all of a sudden got narrow again very quickly. So with that, can you talk a little bit about, you can keep going down the equity road, but like what we're seeing on a weekly basis, the close knows, right? Daily.
No, let's talk about fixed income. That's an important piece.
Yeah.
And it's a piece that clients haven't owned for months, right?
Yeah.
And, we get on senior tier and we talk about stocks a lot, right? I mean, not all of our models, the 4 models we have for clients, are not all 100% equity benchmarks,
Right.
That's not what everyone's risk tolerance is. And yeah, I mean, there's clients that can absolutely own fixed income and have fixed income, and it's part of their model. If fixed income wasn't in a downtrend, but it has been, and oh my God. I mean, you look at the junk, I don't know. I mean, it's 2:00, so maybe they save it in the next 2 hours. Anything is possible, but holy cow.
Well, junk bonds using something like JNK did have a 5.5% bounce from May 19th.
Which is a big bounce. It's a big bounce for fixed income.
But has subsequently gone out at new lows and is at the same level it was back in late March of 2020. So everybody knows what that scenario was the COVID panic crash. And frankly, we're seeing CCC credit spreads continue to move higher.
I mean, that's something we've harped on, and
it's a tightening liquid. I know
David Cox has harped on it.
It's a liquidity tightening environment.
It absolutely is. Yeah. So for context on high yield, those high yield bonds, as of mid-May, we're about 15% off the highs. That's the drop we had seen going back to last September. Then over, a very quick span, 2 weeks maybe, junk bonds bounced 5-6%. Like you said, they've recaptured, a third of that bounce. And we are now back through those lows. So again, bearing any type of miracle, high yield bonds will now be at their worst.
And that's a risk. That's a risk on area of the market.
It is a risk on. That's why we talk about it.
And we're not really seeing that. And here's the deal. Even in this last 2,
AGG, yeah,
AGG aggregate bonds, new lows.
And that's not risk on. That's just your average bond. That's just
correct. And we're rejecting off an area of polarity around 103, 104. What I mean by polarity, for those who aren't familiar with it, is this is an area that had seen support, meaning buyers step up in 2011, saw a buyer step up in 2018 for these type of bonds. We broke through that back in April. We bounced back up into this 103, 104 area and got soundly rejected. So here's an area of the market that's supposed to act as a buoy to individual investor accounts, right? That 60-40 portfolio, 60% stocks, 40% bonds. Typically the 40% is not 100% in high risk credit like junk bonds. It's more owning this broader basket of bonds. And it's not working. That is not helping buoy accounts at all.
I mean, your next stop for, again, let's call this the average bond. We'll call it the average bond in America.
Yeah.
Well, the S&P of bonds. So the next,
for context, AGG, I believe, for the last 20 years has only had one negative total return year. And here we are, 2022, and it's down arguably as much as stocks are.
It's down about, 12% on the year. So your next stop here, technically, this was such a big level. This 104, 103.
Huge.
huge level historically. I mean, your next stop here, and I'm not saying it's going to happen in a straight line, but your next big support here,
$97 maybe.
I mean, yeah, 90. I was going to say 95, 96, 90, yeah, 97 exactly. And, we have this 08 low off bottom. Obviously that was, that could also be support. We get below 96, 97. Yeah, that's your next stop.
Right.
And 96, 97 is another 4%, 5%.
So the credit market is matching what we're seeing in equities, meaning it's not healthy. We don't want to see, from a liquidity perspective, CCC credit spreads moving higher like they are. These instruments like this, these safe havens selling off in addition to equities. So there's really no safe place to hide. And I know that we like to look at like semiconductors and transportation stocks.
Oh, transports. Another one I mentioned it earlier. It's going to be on maybe the worst of a lot. I mean, outside of cannabis, as far as just just straight up new lows. I mean,
and it's, I mean, awful. For technicians out there, IYT is on a weekly time frame is a classic double top. And, below 244, basically confirmed that's in play, with the next level of support somewhere around 199, which is about 20% lower from here. Again, I'm not trying to be a doomsdayer. I'm just identifying the facts that I see. That's what the chart says. And so here we have semiconductors and transportation stocks, things that are economically sensitive that we would, you'd see them do well when the market's doing well. And we're not seeing that. I would also point out, in the past, we've talked plenty about commodities. We've owned commodities. We've owned anything from nickel, cotton,
aluminum,
oil.
Tin.
Yeah. And we're not.
Sugar.
I would also make an argument that that's narrowing out.
It is. I mean, outside of crude. I mean, you get days here and there where grains does something, or
natural gas, crude, gasoline futures. Of course, everyone's seeing that at the pump. And
cotton's held up. Cotton's held up well. Soybeans have held up well, but grains as a whole, not really.
But this goes back to
I should say how they just haven't done any. They've been consolidating since early March.
Right.
Like you look at grains, it's just a sideways 20% range.
Yeah. And maybe some consolidation in sugar, but the point being that yes, there's strength in commodities, but it's not like what we saw earlier in the year. It's narrower. It's definitely towards the energy type commodities.
In fact, your industrial metals aluminum looks pretty rough.
Copper, I think about
copper. Yeah.
I mean, today's kind of a pretty big event in copper, in my opinion. We're still within, if we were to use copper futures.
Well, and of course, copper gold, which was looking fine.
Yeah.
Another risk on barometer back to the bottom of that range. Heading back towards the bottom, or depending on where you want to draw your line.
But there's supply in the 4 spot 55 in copper futures. Sellers continue to show up above that level. And I mean, we really need copper to hold 408, 4 spot 08. And if that doesn't, that's going to be further confirmation of risk off. I think that falls in the same category as healthcare and the 125 level. Like if you're seeing those levels broken, we've got definitely sellers in control across the broad market. We're even seeing it in crypto, right?
Yeah,
we're losing important levels.
You want to talk about a consolidation? Bitcoin basically hung around 30,000 for.
It's been a month now.
2 months. Well, yeah, a month here. They tried to push it higher on May 30th. That got slapped down a couple days later, and it hasn't broken down yet, but
it's on the verge. They're right there. And again, that's not a prediction.
And Ethereum has hit, this 1725 level. Pretty big for Ethereum. And should they ring the bell right now, we would be going home below that. So,
and if you're looking for a bright spot in crypto land, maybe it's helium reclaiming potentially a false.
I thought you were going to say Luna 2.0. I thought you were going to tell me I was going to be able to cash out.
Yeah,
No,
sorry.
Oh, dang.
Bad.
I thought for sure that was gonna work.
Right. And so, and this goes back to Ian, when we talked about there are stages to bull markets and bear markets. And when you see bonds down, stocks down, commodities up, that typically is the final stage of a bull. And if we see commodities roll over, you talked about crude oil. If we're seeing crude oil, and I believe I'm using West Texas crude here, if we're seeing that also be a false breakout, if we don't see 122, 123 held or reclaimed, and we see this roll over, now we're starting to talk about that first stage of a bear where like everything's moving together.
Yeah.
It doesn't matter. If your credit, if your equity, if your commodities, and now even if you're crypto and Bitcoin's breaking below 30,000 and Ethereum's below 1725, all these things are moving in unison. Now you're talking about deflationary type event, which is not what.
Yeah, like a real bear market.
And here we're talking about deflationary event on the very day that the biggest noise event was CPI. So this is why we use price, because price trumps anything that, some people's critique of using technical analysis and studying prices. It's looking at the past information, and the argument would be, well, you let me know if you have the data from the future, and we can go ahead and look at that. But price is the most recent information that's considered.
Put that on my Christmas list every year.
Right.
Still haven't gotten it.
I know. Hey, put it on there again.
I am.
See what happens. Hey, so we're bumped up against the edge of our client portion of the podcast. In the extended portion, some teasers. We're going to talk about island reversals, advanced decline line, some of the ratios we're looking at, and then take it from there. So we hope you guys stay on from that. But before we sign off and go to the extended portion, anything you want to wrap up with, Ian?
No, just that, clients will notice right in this first section of the podcast is for them, but you'll notice that, we got more involved over the last few weeks and nibbled, and there were certainly charts that look great and fit our criteria. And we saw some things happening that we wanted to happen. And, the chart tells you to buy, and sometimes very quickly the chart can tell you to sell. And so that's what it said yesterday. And so that's why you've seen the action you see in your portfolio. And yes, follow through today. We'll see where we close. We'll see where this even goes next week. But
we'll continue.
We have our levels we have our levels in mind. Those were broke. Our levels were broken yesterday. So
and important levels were never reclaimed, and so we'll adapt. That's why we're adaptive, and we'll continue to do that on a disciplined basis for our clients, and we'll take it day by day. And so we appreciate continued client confidence in our approach. And with that, we hope everybody enjoys this podcast, stays on for the extended portion, and we'll be back next week.
Have a great weekend, everyone.
All right, Ian, jumping into the extended portion, not a lot of time left, so we might do a blitzkrieg, if you will. We'll go through these really quick. Island reversals. What are they?
Island reversals.
What are they? What are we seeing?
Island reversals, gap up, price consolidates, sometimes for 1 day or 2 days, sometimes multiple days. It's one we've seen. Now, are we? I would say you could see this on the S&P.
The best one to see it on is Global 100.
XH, no, not really. Okay, VOO.
Or no, IOO.
Oh, IOO.
Look at that thing.
IOO. Yeah, so this is what, and this actually happened yesterday. Dave spotted this during our market call, which then led us to basically say, okay, well, is this foreshadowing what's going to happen to everything else tomorrow? That is what has happened to everything else tomorrow, which is now today. But yeah, so you get the gap up, you consolidate for a period of time, and then you get an equivalent gap. Like, there's a range there that's in theory never touched by price.
Right.
So that creates this island. For IOO, you could say it was 69 to 69.40.
Yeah.
That never got touched. Yet spent, almost 2 weeks above that level.
And then they quickly sold it off, leaving
And
this
now
island.
it's trading at 65. But yet price never traded in between those prices.
Yep. Move quickly lower. And we're seeing that across all sorts of things. You can make an argument that it happened in Latin America. You can make an argument that it happened in semiconductors. It's not as clear, but XLK would be another one.
Right? We like to talk about the essence. You like to talk about the essence.
Yeah, it's there. These are island reversals. And
I'd say in Germany, but it was actually way worse than an island reversal. You got the island, but the gap was the gap took out the whole coastline. Took out the whole coastline. That was a hurricane.
I don't know. That's almost like, I don't even know what to describe that. A moving sandbar. I don't know what that is.
Yeah, and like I said earlier in the first portion of the podcast, same with Australia. And these these areas that had been ranking very high in our relative rankings. I'm not saying they were buyable per se, but they had held up on a relative basis much better than U.S. equities. Whew.
Yeah. It's worth noting, and we're seeing it across a lot of different things.
Switzerland, Switzerland was new lows yesterday, and now today follow through.
What are you using for that one?
EWL.
Yeah.
Now below its COVID gap, below its COVID highs today. You got Switzerland down 10% in the last 2 weeks, or last week.
Yeah, that's rough. That's legit. And then we're seeing this across a fair amount of things.
Emerging markets with an island reversal.
Yeah. And that was even with, China looking so good.
Yeah, and that's with 40% of your freaking index.
And I think it's worth noting that going back to Latin America or Brazil, right? Looking at the Brazilian real, looking at something like USD, BRL. Here you have that currency pair wrapping around the prior again. And this is another market characteristic we've seen for the past, year to 18 months is you get these previous horizontal levels broken, but then price wraps around that horizontal level, shaking out the most participants. And then it's really what happens after that compression or that consolidation breaks. And you got to keep that in mind. Something like USD BRL, as long as it's wrapping around this $5 level, you got to be careful what's going on in Latin American stocks. And that's a big part of emerging market stocks. And if we can't get leadership if we have failed breakouts on our hands on Chinese internet, which that's TBD, but if you do, China is also a huge part of emerging markets. And I know one area that we got excited about as far as being a green shooter, green piece of grass was microcaps.
Yeah.
And
they were the only one green last week. They had, same approach to their ranges, small caps. But yeah, trashed like everything. And that micro caps, right? If you think about on the risk spectrum, if you're going to take risk in the market, you're going to buy more micro caps than you will small caps, where there will be outpacing demand for micro caps than there would be for small caps. Yeah. And that was actually starting to take place. It was.
And then they evaporated it.
And that happens. The chart is the chart. It is.
It is. No, price is price.
Yeah.
The chart is the chart.
It's like in March 2020, late February, when things started to break down and you sold and you don't know what's around the corner. You don't know it was another 25, 30%, but charts said you don't need to own this.
Right. And I think now would be an appropriate time just to kind of talk about some of the breadth measures we were seeing. I alluded to in the first part.
What are you seeing out there in breadth?
Well, we had those 80% up days. And I know Mark Ungerwitter had a nice chart about like seeing price breadth thrusts like this tend to happen during lows. That meant May 25, 26, 27, 80% up days, that tends to be areas that you see lows take place, but it also can take place in downtrends that are significant, that it's not the end of the downtrend. For example, 0809, it takes place, but then price then turns down lower. And the 93% down day yesterday, Thursday, is a big deal. That is a lot of selling. That is a lot of supply in the market. And then when we think about breadth overall, right, we've got advanced decline lines, new highs, new lows. What are we seeing out of those?
I actually haven't looked at that. I haven't looked at new highs, new lows in a couple of days. But I mean, we're back to now the short-term one's a little bit better. But you look at New York Stock Exchange. Now this is today, although we'll see what the data is.
And you're talking new highs, new lows, or you're talking advanced decline line?
I'm talking about advanced decline line.
Okay.
Why? What are you seeing?
No. I was just going to say advanced decline line for S&P gave I think some people some hope, right? Because you did have a little bit of divergence in the lows, but more broadly speaking, right? NYSE is a broader basket, and it's definitely confirming a downtrend. I mean, it's lower lows and lower highs in the advanced decline line for NYSE.
And I think you had brought up on the advanced decline line and a lot of these moving average breadth Wednesday, you mentioned that. So price recaptures the March lows.
Right.
But breadth never does.
Correct. And so it's like a breadth bounce within a downtrend, which can happen, which is kind of the essence of Mark Ungerwitter's chart, is just, yes, these broad breadth expansion can and do happen at market bottoms, but you have to have follow through. And the follow through in this case would have been this consolidation that Ian was talking about between, starting May 27th in S&P between 40.80 and 41.80, that 100-point range. If you were going to see breadth expansion follow through, it would have broken higher. That's what quote unquote should have happened. I don't mean should have happened as some type of predictive behavior, but I think we've made this analogy in the past. If you're on the goal line and you can't get it in on 4 downs, there might be a problem with your offensive line. There might be a problem with your offense if you can't get that last yard. And if that happens,
great point.
And that's kind of what
maybe you just don't have the demand.
Yeah, you don't have the demand that you need
to get that touchdown.
Yeah, that's right, to get that touchdown. And how about new highs, new lows? I know that's something we track.
Back to negative yesterday. That was another red flag, triple digit negative, and we stayed. New highs, new lows had been positive for a few days. Not,
it had
exciting. Really, really a couple. So it's there was a flat session in there, about 6 or 7 sessions. Like I said, nothing dramatic. I mean, I think the best session was plus 72. It was on May 31st. But yesterday, putting in a negative 107 or negative 99. And then today, we're in the negative 200. So
we have weak breath on our hands. One thing that I think about is the strength out of energy we've seen for the past few months, that XLE versus S&P relationship. If you're to take a look at that chart and zoom out, there is a measured target on that relationship of, taking the base that starts in November 2020 and taking it to the top of the base. It's about 65 to 68% measured target. We're reaching that right now and have reversed. Do we now see energy join the party to the downside?
Yeah, that would be somewhat either final flushy or Yeah, we just don't want to own anything. I mean, final flush is going to happen for unless, I don't know, I think of December 2018. But then you can also, I mean, October through October 2008 to March 2009 could be considered a final flush.
Yes.
That was 6 months. So
yeah, no, totally true. The evidence continues to confirm that we're in a downtrend, that we have a bear market on our hands. And until we've talked about how many times until we see stocks stop going down, that's what we're in. That's the reality of the situation. And there's not really much else to say about it because it's just the evidence at hand. And so we manage risk accordingly. So with that, we're kind of wrapped up with what we wanted to cover in the extended portion. Anything else, Ian, that stuck out to you that you wanted to cover that's worth noting? I know that there's plenty from this week, and it could be like weekly charts. What we're, I think there's
think the weekly. I mean, you say you're going to end up with a bearish engulfing, most likely on IWM. So that's not going to be great.
Yeah, you're going to have some potentially. Now we've got an hour and a half.
And it was right into resistance. I mean, you can, pull up a blank weekly chart, remove every single line. I mean, I'm just talking about just candles, and you draw a line. You draw a line or horizontally at 190, 191, wherever, 191.
Okay.
And then say, okay, yeah, that makes sense. What happened? Like this candle, the rejection here makes sense.
Yeah.
This used to be a place where they would come in and save it. I mean, they spent months saving it. And does that turn into, and when I say saving it, I mean buyers coming in at 191, 192 and moving it back higher. So I think that when you have that much supply for months, literally months, I mean, it was a majority of Q1 and into April. I mean, it was 3-4 months. And then it breaks.
Yeah.
I mean, that's just so much like mental, but I'm not even talking about like money supply. Like there's like mental, emotional supply there that was broken. And
that's why
you could say the exact same behavior now. I don't want to say this is be a nightmare as a trend follower, but yeah, I mean, you could see that behavior. Like we could spend all summer doing this underneath 191.
Yeah. Well, and that goes back to if we keep in mind our market mile markers of February 2021, again, so this bear market's not new. The majority of stocks have been doing what we're talking about today for over a year. And now we're starting to see the big boys participate to the downside, the big boys being the ones we talked about before, Microsoft, Apple, Amazon, Google, you name it. And that's why Fibonacci ratios are so fascinating, right? Because if we bounce back up 38%, 50%, 68%, excuse me, I didn't say the right numbers, but the point being these levels have significance because people will emotionally react of, oh my goodness, thankfully I got half my money back. And then they sell. And that's the danger of the market we're in now is any bounce gets sold because if people are trying to quote unquote buy the dip, which are you going to buy the dip?
Dude, there's institutional managers that still haven't got, there's people that definitely have not thrown in the towel yet.
No, not for sure. So the evidence price wise broadly and individual stock wise. So individual stock, we saw some green shoots this week. They took that away, false breakouts. Broadly, confirmation of further downside, lower lows, lower highs. Now we have downward sloping moving averages. The risk continues to be towards more downside. We're in an environment where we're seeing dollar strength, which I think is still, I don't mean hilarious and like I'm laughing at people, but like the mantra for the past year was crypto. And here we're seeing the antithesis, like what people argue against, fiat outperforming. And here we're on the verge of seeing maybe Bitcoin and Ethereum break down. Mm-hmm. That would be classic behavior. We'll see. Only time will tell. And that's the hardest part is sometimes you have to wait to get the information you need. But right now, the evidence continues to support that we're going to see further downside in stocks. Maybe not. Maybe we see a double bottom here and we move higher. So we've reached the end of the podcast, Ian. Great insights this week. I'll give you one final shot at anything you want to touch base on before we get out of here.
No, I think I covered it all. It's going to most likely end up being a pretty ugly result to what had been a constructive rally.
Yeah.
And that's what happens in bear markets.
Absolutely.
You participate in case it's a V bottom. Not saying you rush in, but you nibble.
Mm-hmm.
And if the food starts to turn bad, you got to quickly be out the door. So that's what we try to do.
Absolutely. So with that, we'll wrap up the podcast. Great job, Ian. Great to be back on here with you. To everybody listening, we appreciate it. To our clients, we appreciate it. That's all we've got. We'll do it again in a week. You guys take care.
Have a great weekend, everyone.